Good morning, everyone, or afternoon if you're listening to this in the afternoon, or evening if you are taking time out of your evening to listen to this, which I appreciate. But just wanted to introduce this week's presentation and kind of jump into it here. We are going to be talking today about planning before your 40s. So, really focusing on planning when you are in your late 20s or when you are in your early to mid 30s at that point. Really, what the focus of this is going to be talking about a lot of the pain points I've seen and a lot of the pain points you typically experience when you are transitioning from really being dependent on a family unit into financial independence in your later 20s and your 30s. There's just a lot of really big events that happen. There's a lot of milestones that take place, and it's very hard to go through that period of time and be able to think about retirement savings because just so much is happening. It's very easy to just blink and you're suddenly in your late 30s and things are starting to slow down a little bit. So I wanted to do a presentation really specifically geared towards those individuals and really walk through some of the major events you'll be going through. What are some things you should be thinking about when you are going through those? And then how to keep your retirement plan kind of in focus, or at least how you should handle it or look at handling it when you have all of these other major events that do typically have a rather significant expense associated with them at that point. So we'll walk through them first and we'll kind of dig down into them a little bit more. But you're going to get married. More than likely, you're going to get married during this time period. Hopefully, it's your first one and or your only one, but you will keep getting married. So conversations around merging finances, managing finances as a household all come into play at this point. But it's something that I always encourage people to do as they are, if they are recently married, just getting married or planning on getting married, just making sure they have those conversations. You're also going to be looking at potentially having a child, usually in this time period as well. So probably late 20s or early 30s is where we typically see most people have start having children as of right now, and that might be a child or it might be multiple children. You're also navigating the earliest part of your career, so you're starting to look at where is your career trajectory going? What is the income potential for your career? And I like to kind of pause on this one for a little bit because your career is such a driving factor of your financial success, because there's really two things that come into play with financial success: your ability to save and your ability to earn. So you're managing kind of that income and then managing how, like, your debt at that point. So it's really income and debt. So savings and earnings at that point. Now, if you are fine with a certain lifestyle and you are in a career that you enjoy and that career has a lower lifetime earning potential, so like the potential for you to make a lot more money might not be on the road you're currently on. If that fits your spending goals and your financial goals and you are happy, that is probably the best place for you to be, because a lot of people never even get to that point. However, if you have financial goals or spending goals that are much higher, you need to make sure you are really looking at your career path and looking at where that earning potential is going to start to cap at, because that is something that you need to make sure matches with what your overall plan is and what your overall kind of goal is at that point. So keep that in mind when you're in this period. You have some flexibility to change careers, to pivot at that point, but keep that in mind. Also, major purchases. You're looking at buying a house and buying a car during this period. So you're looking at starting to acquire a lot of debt, and you're looking at leveraging yourself a little good bit. This can be a great way to build future net worth, but it can also be a great way to really cement yourself into having to deal with debt for the rest of your life. Now, ultimately, what we want to look at is how do we build a plan around all of these different events? Because all of these different events are taking place in a very short window of time. So your lifetime is or at least your working career is several decades at that point in time. This typically takes place within 1 decade. So you get past a lot of these events, and again, life starts to slow down. Things start to get a little bit more consistent. You don't run into as many major shifts or changes at that point in time. So, how do you manage this point in time in your life? Because it is something that is very important, and can set yourself up for a really great future, or can set yourself up to where you're having to play catch up for a lot of years. So that's what we want to look at. I want to talk through today, kind of how can you handle these in a wise manner. First off, I want to go over some strengths and weaknesses of someone in this time period at this point. So, some strengths, you have time and you have flexibility. So, time for this strength means you do not have to rush into something, and it kind of blends in with flexibility. You don't have to put a ton of money into investments for them to grow substantially. You don't have to really race to try and build your income really quickly. You have time to really sit back, think through, all right, is this a career path I want? You can slowly build your investments. You have time to build a savings. You have the flexibility to where if you do want to move to a different career path, there are entry level positions that you can move to fairly easily, and it's not going to be a huge step backwards for you, or it might not even be a step backwards for you. And you have flexibility to make those adjustments at that point in time. So, those are two huge strengths that you don't necessarily have later in life. Like, you get later into a career and your resume starts to show 10, 15 years honed into one industry. If you want to move industries, it becomes substantially harder, especially if it involves you having to take a significant step back when maybe your regular expense just cannot handle the drop in income. Now, weaknesses, you have a lot of major life changes, and these are major changes that are really going to affect the way your financial life functions for a very long time. So it's not going to be, I changed my haircut at that point in time, which can be a major change, or something you don't have to worry about if your hair is slowly losing at that point. But these are going to be changes where you are ultimately seeing dramatic shifts going forward. So, starting a new career, that can change your workload, that can change your work time, that can change the relationship you have with your family and work, what that kind of symbiosis looks like at that point. It can change what your future earning potential could be. Starting a family, that is a huge one, changes the amount of time you get to sleep, changes how your family or how your household operates at that point, changes expenses very dramatically, and it changes those for essentially from there forward at that point. And then moving into a home, so you're going from renting to owning a home. So you might be looking at a rent that's equivalent to a mortgage, but there's going to be excess costs associated with that. So home upkeep, one-time expenses. You do have a large amount of debt typically at this point in time, so you have to make sure you have some sort of income stability to manage that. So just a lot more responsibility with all of those major changes. And in turn, when you're doing all of those, you typically are going to have fairly low resources. Even if you have found a position that pays relatively well at this point, entry level, it's still probably going to be on the lower end of what you would normally be making in the prime of your career in like your late 40s and 50s. Also, you typically have probably not had time to build up an appropriate savings account or an appropriate short term nest egg at this point. So, all of these major changes that you are going through typically are going to require a good deal of cash on hand. They're going to have a lot of upfront costs, and it's not going to be something you would have necessarily had time to build up into. So, you're having to navigate probably taking on a little bit more debt than you might necessarily be comfortable with, or pushing some of these purchases or some of these major changes out a few years until you feel like you're financially slightly more stable, which isn't necessarily a bad thing. And again, that's where time comes in to be a strength. So when we talk about all these, the question then becomes, where do we start? So where do we start in starting to plan around this? And I like to start at the most base level, which is your cash flow. So your monthly cash flow would be really where I recommend everyone start. And this might be something where you already have this down pat. You know what money comes in, you know where your money's going, and this is a huge, pretty easy point for you to manage. But this is a very huge thing. Cash flow management, the ability to manage what debts you have, what income you have, whether it's through budgeting or just tracking, whatever works for you. But the ability to manage this effectively is the base of your entire financial life. Having a healthy cash flow and a healthy budget is hugely important. And it bleeds into a lot of other purchases you have, and it bleeds into a lot of retirement planning as well. Because if you aren't able to manage your month to month expenses, if you cannot adjust them for the income you have, or if you don't even know where you're sitting on that point, you aren't going to be able to build a successful plan off of that. You really are going to need to have some sort of framework in place, whether it is a traditional budget, whether it's just a tracking system, just something so that you know where you sit. I've seen people that have always been able to out earn the need to have a budget. That eventually stops when you retire, and then it becomes extremely important and it is extremely hard to adjust that. So, starting this early, having this be a foundation of your financial plan is huge, especially when you're going through a period where you know you are about to have a lot of financial outlays very, very quickly at that point in time. And you're coming out of a period too with low resources, and probably you're going to end up either you already have some debt or you have debt that you will be taking on at some point in time. So part of this is managing your debt, and part of it is managing your income. So let's start with debt and go at just this is average debt by age group. So again, this is an average debt by a national age group. So Gen Z, if you are essentially sub 25, it's probably mostly student loans. If you're millennials, 25 to 34, probably credit cards if you haven't bought a house already. As we get a little bit older, Gen Z and baby boomers, you get credit cards, and mortgages are typically the primary debts you see. Now, what is important about this is managing your debt to income ratio. So, debt to income ratio is the amount of debt you have on a monthly basis divided by the amount of income. So, if we were to look at that, you have a mortgage, student loans, maybe that $400 debt's a car payment, maybe it's credit cards, whatever it might be. And then you have $6,000 of monthly income. Pardon me. Now, this says gross. I typically like to recommend using your net income at this point just because it's a little bit more realistic for your actual spending because it's already, you don't have to worry about taking tax into account at that point because it's already taken out of your paycheck. But this debt to income ratio would be 33% because you take those top numbers and you divide them by that 6,000. Now, what does that mean? You want it to be healthy. Now, what is healthy? Healthy is having that debt to income ratio below 35%. Most people keep it somewhere between 35 and 50. If it's over 50, that is not healthy. Now, why does this matter? This matters because if you have a debt to income ratio that's over 50, the likelihood is you are either making a lot and that another 50% is more than enough to cover. But if you're one of the other 99% of individuals, you are probably living pretty closely, if not paycheck to paycheck, and you are just getting by being able to cover minimum payments on most of your debt. So that could be car payments, mortgage, credit cards. Why this is important, why it's especially important here, is if you allow yourself to buy a first car or to buy a home that really, really stretches your debt to income ratio, that puts you over that 50. One, more than likely, it's going to mean you got a worse interest rate than you could have. But two, what that looks like is if you have anything that goes wrong in your financial life, which is almost a guarantee that that will happen, it gives you very limited resources to have any sort of flexibility. Because if you look at your income and over 50% of it is just going to service debt, I mean, that's debt before you get to utilities, before you get to food, before you get to clothing, before you get to transportation cost. Like, that's a large portion. So you're probably not looking at the ability to save all that much. And if you do have an emergency, the probability of you having to put that into debt, so onto credit cards or whatever it might be, is fairly high, which can essentially put you in a cycle of never being able to actually save for retirement, never being able to actually really get ahead, but you just position yourself to where it's always debt, 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 to where you can't get out of that cycle. And eventually that usually ends up in bankruptcy. Now, if you're in that 35 to 50, it's workable. I mean, you could be on the lower end of that. Most people in this range, again, is your incomes are slightly lower. You will probably find yourself into that 35 to 50% range. That's not terrible and it's not a bad thing. It's just one of those things you usually don't see people hit that 35 until, again, life starts to calm down. Maybe they get a car paid off at that point in time. And their income starts to rise with their career at that point. But if you can stay between 35 and 50 in this period of time, I'd say you're usually doing pretty solid because you're taking on a mortgage, you're taking on a car payment, you're probably finishing off student loans at this point in time, and you might be taking on like medical or credit card debt with the cost of a child at that point in time. Just keep that in mind and use that as a metric for how healthy your kind of cash flow month to month is. It's something that is hugely important and kind of trickles into a lot of other things when it comes to lending and credit score as well. So, nextly, so that's kind of managing your debt. The other thing would be managing your income because that's going to be the other thing that is the counterpoint to debt is all right. Well, if you want your debt to income to be ratio to be lower, you can get less debt or you can get more income. So those are really the two options you have. And at a certain point, the amount of debt you have can only go so low. Like if you have a house and a car and no credit card debt, if your house is still 50% of your income, really the only option you have is find more income. So navigate a career change or something along those lines. Or it's move into a much smaller affordable house or move further out from where you are. So there's some other triggers or levers you could pull, but it is something that there's really just two options you have to. So when it comes to navigating salary, again, starting salaries are typically going to be the lowest you have. You do have that flexibility in this window because, again, when you look at that starting salary, if you were to move positions, you could probably move into another entry level and be probably a even horizontal move at that point in time. You might even be able to leverage up your salary a little bit. And a lot of people during this time do make multiple, even if they stay in the same career path, multiple moves from different companies to leverage that salary up a little bit higher. So that's one way to do it. I always like to say, just know that that doesn't go on forever. I have seen people say, "Oh, well, I'll get a big bonus or I'll get a raise next year." And they're hitting that point where like you tend to see incomes flatline a little bit. So, but they'll say, "Oh, I'll just keep getting bonuses or I'll keep getting raises pretty substantially or I'll just move to another company, be able to leverage my income a little bit." That works if you're entry level or maybe a few positions above that, but you're going to get to a point eventually where it's very hard to get a promotion. I always say like there's a lot of like think of it like a pyramid. There's a lot of entry level people. There's a lot of like senior entry level. Then you get to manager, then senior manager, director, VP, C-suite. Well, there's very few C-suite, very few VPs, very few directors for any company. So you're going to get to a point in your career where you're probably capped out on like significant raises. You're probably capped out on promotions, and it becomes far, far more competitive to move up at that point. So I say that because on average, you typically see incomes rise the quickest until you get to your late 30s and then they plateau. So you see women's right here, men's right here. Women's actually tend to rise faster in the early portion of their career. And then usually within these statistics, you have the women that choose to stay home just because, again, that's still a primary like women do tend to stay home more than men. Just as of right now, that's kind of changing a little bit. But either way, whether you move on this track or not, regardless, you see this late 30s period is where you start to flatline a little bit on either position. And the main reason because of that is, again, what we just talked about. the lack of upward mobility starts to kind of arise because you've already gone through the ranks at that point. So you're looking at potentially just cost of living raises or very mild raises throughout that point. So I say that to say, if you're planning on in your late 30s, oh, well, I'll just pay this off because I'm going to be able to get this promotion. Those start to go away very quickly, and you start to see, all right, this is my income peak. I'm probably cap lined out, and then it's going to be cost of living from here on out. So I see a lot of people really excited in their early 30s because they're seeing these massive raises, and then that starts to trickle off because they're getting to the top of their pay scale and they don't have any upwards mobility in their current company. And that's not a bad thing either. Like, if you are happy at your company, you don't have upwards mobility, your income is good for what you need, what your lifestyle is. And like, there isn't a need for you to constantly be growing your income if it sustains you, your retirement plan, and you are happy. It's one thing to like to always think the grass is greener, if you will, but a lot of people can't say that they're happy at their career and might just be in it for the money. But if you find a company that you feel valued in or has great benefits and your salary is perfect for you and the work life balance is great, I mean, that is phenomenal. You're not living your life for your career. The career is supposed to be a means to enjoy the rest of your life at that point. So, I again don't think that's necessarily a bad thing. Just know when you're planning your career path, look at those salary ranges at that time out, or look at and talk to individuals further along in your company than you and say, hey, what does life look like at 45 at this point? What does life look like at 50? What can I expect? And if that's something that you don't like, possibly look at moving. But just know that. And then lastly, I mean, you're getting married at this point. So before we go into major expenses, the last thing is you're merging finances. So if you were getting married during this time period or you are getting married, just know you are merging your finances with another individual. And that could be another individual that has a completely different relationship with money than you do at that point. So So I say that to say, like it could be someone whose family's never talked about money, or someone whose family's always been very open with money. You just get a lot of different kind of backgrounds of how people treat it, how people think about it, what it is. It's one of those things that can be very stigmatized at that point. I'd say most relationship issues do revolve somehow around money. So you don't have to merge your finances completely. Like, so some couples do 100% merge where everything's joint. Some couples keep separate accounts and just split the expenses. I've seen people that have been successful and happy with both avenues. So it's really just navigating, making sure you've had that conversation and then both spouses are on board. That's probably the bigger thing is it's a conversation, and it's a conversation where both spouses truly are on board at that point in time. Because when it becomes an issue is when you're not on the same page at that point. So just make sure it is something you talk about, it's something you refer to regularly, and then there's buy-in from each party on what your retirement plan is, what your spending expectations are, so you can kind of plan around that. Now, getting into major purchases or major expenses, the first one we're going to start with isn't necessarily a major purchase, but it is a major expense: having a child. So, having a child tends to be extremely expensive, not just for the having the child part, but also the raising the child part is a lot more expensive as well. So, but we're going to focus on having a child because a lot of the raising a child might happen closer into like that 40s and 50s as well, where you get to college costs and things like that. But having a child, that's typically going to happen here. So I want to first look at just what childbirth costs at this point in time. So average childbirth cost can range from like 18 to 26. Out of pocket can range from 26 to 3,200 at that point. Now, this can kind of vary based on your healthcare plan. It can vary on what time of year you have the child as to how much of your deductible you've already hit at that point. So just know there is cost related to that. It could be somewhere like to 500 if you've already covered a lot of out of pocket, or it could be a few thousand, upwards 5,000, 6,000 in some cases. So just know there are going to be costs associated with that, and they might be a little bit higher depending on how long you stay in the hospital at that point. But there are going to be some child care costs related to it. So you want to have that kind of in mind. You're also going to have child care cost after the child's born. So, like a per week basis, you could be ranging anywhere from like $560 to about $201 a month. Um, that's going to range again just based on daycare, if you do nanny, if you do part time daycare. And it's also going to look at this is for one child. So, if you have multiple children, you can essentially just double these numbers. And that's when it really looks at, all right, is a spouse going to stay home for a few years until the child is old enough to go into like school, like kindergarten or something along those lines? Does it make sense if one spouse's salary is going fully to childcare, or to just have a spouse stay home and watch the kid at that point? But in our area specifically, I've like priced out a couple of them. It usually ranges from like 220 to 305 per week. So like pretty spot on to those averages. If you were to do it here, I've priced these out because I'm having a child end of this year. So already kind of planning around that. But there's also the unexpected cost with having children at this point. So you're going to have all of these little things that build up leading up to it. So you're going to have a kind of convenience cost, essentially supply costs, so like childcare, nursing supplies, outfits, bottles. It's going to increase your utility bills, maternity clothes, time off from work to go to doctor's appointments, or time off of work if you don't have a maternity or paternity leave, but you are taking time off. You might be going on short-term disability if you have that, or you might just be using PTO at that point, or using voluntary unpaid time off if you have that option. You're probably going to be looking at just hospital costs associated with that. So outside of the actual having the child and childcare, there's also a lot of ancillary cost as well that will continue on, especially early on at that point. So next is going to be buying a car and buying a house. Those are going to be the next big expenses. But before I jump into buying a car and buying a house, what I want to talk about is credit score, because credit score is often, I think, slightly overblown with the way people talk about it. And I think so. I think it's two ways. It's either overblown or it's underrated in a sense. I was trying to think of the counter word to overblown. I don't think it's underrated, but I'm not sure. So people either pay too much attention to it, or they're like, you don't need it all. And I think it's probably somewhere in closer to the you don't need it at all than the overblown, but it is something that can be valuable at times. And it is something that I think isn't as valuable as a lot of people make it out to be. I think there's just been a lot of discussion around it over the years, to where it has become a number that people can associate with their financial well-being that isn't necessarily as useful in their day-to-day outside of a few lifetime major purchases. So ultimately what a credit score is it is a number that tells a lender, are you credit worthy or are you not? So if you're a 300 credit score, no one's lending to you because you're a super high risk individual. You're the guy that never pays people back. That's you. If you are at a 50 credit score, you are a great individual. You always pay people back. People want to lend money to you. So what's the range? Typically, like, you want to keep your credit score, give or take, probably a little north of 740 would be very good. Really poor, again, 3 to 500s, 5 to 600s at that point. But when you get into credit scores, I mean, why does that number matter? So that number matters because it affects the interest rates you can get on major purchases. And this is where a credit score comes into play, but it's also something that is not necessarily the largest factor in these purchases. So that's where I think it can get kind of overblown. So if you care, let's start at the bottom and work our way up. So if you carry credit card debt, it's going to matter because you have a lower interest or a lower credit score. Your credit interest rate is going to be typically higher. Ideally, if you have a healthy cash flow, you're not carrying credit card debt. So in this case, if you don't carry credit card debt, which ideally you shouldn't anyways, because even 11.99 in a great year is good. And with interest rates the way they are now, good luck even with a great credit score getting that low of a rate. You're still paying an outrageous amount for an unsecured debt at that point. So realistically, you shouldn't have credit card debt anyways, if possible. But if you have a low credit score, your interest rate might be slightly higher. Now, these numbers across the board on all four of these are probably exaggerated. There's a lot more factors that play into the interest rate than just your credit score. It does play a factor, but it's not going to swing it by 10 to 15% more than likely. But no, so I say it's overblown because you probably shouldn't be having credit card debt anyways. And if you don't have credit card debt, it doesn't matter what your credit score is because you don't have a credit card. Insurance rates, this blends. So, and it doesn't affect all insurance rates. So I'm going to skip over it. And again, there's a lot of factors that affect your rate premium much more than your credit score. Auto loans. So this is auto loans. This can affect a little bit as well. So auto loans and mortgage rates are probably the two realer ones that realistically everyone's going to have that. You can have a healthy cash flow and a healthy debt to income ratio and have mortgage and auto loans at this point. So there is going to be some effect there. So if you regularly pay your bills, if you regularly pay everything on time, naturally your credit score is going to be pretty good. It might not be 850 or something like that, but it'll be good enough to where there's not going to be a worry. And two, if you have your debt to income ratio at a recent amount, most lenders look at that as well and can give you favorable rates for that. But again, when you're purchasing a car, are you purchasing a car you can afford, or are you purchasing the car you want, and are you trying to fit your budget around it? So I would make the argument where credit scores, again, slightly overblown. Yes, you can get a better interest rate, but if you're getting a better interest rate on a car you already can't afford, you're making a bad financial decision. Doesn't matter what your credit score is. If you're buying a car you can afford, and then it doesn't matter what the rate is. If you are planning around, I have this budget per month, regardless of what your credit score is, it might allow you to get a higher trim level. Possibly, it's probably not going to jump you from a sedan to like a supercar, having a cheaper interest rate at that point, but you're already planning around for what your current monthly cash flow looks like, then your credit score becomes much less of a factor. It can maybe, again, get you a slightly higher trim model or a little bit more bells and whistles, but it's not going to make huge moves and allow you to buy a nicer car or a nicer model of car at that point. Mortgage rates. So mortgage rates are probably the biggest one because over the life of the loan, that's where it really affects you. So having a higher credit score is doable. Again, there are so many more, and we'll get to this, things that affect mortgage rates outside of your credit score, that it tends to be a smaller one. And even if you are younger and you don't have a great credit score because of lack of credit history, which we'll get to in a second, you can essentially have a number of different ways a lender can work with you with either your income, your debt to income ratio, looking at past tax returns. That takes a little bit more legwork, but can be done to still give a viable financial picture for yourself. And again, you're still looking at buying a house that you can afford at that point in time. So just know that it's matters because it can affect your interest rate, which especially on the mortgage, that's probably the biggest one. On something that long, that 1 or 2% can be huge from the amount you're paying, but it is not the end all be all, and it's not moving you solely just based on what that credit score is. There's so many other factors that affect those interest rates. What affects your credit score? So amounts owed, payment history, and credit history are the biggest. That makes up 80% of that score. Credit mix and new credit is going to be smaller avenues. So again, if you were younger, naturally your credit score is just going to be a little bit lower. Again, if you want to build it, set up automatic payments. You can report utilities, you can report rent. There are third party services that you can report those to the big credit agencies at that point, and that can really boost you. You don't have to take out credit cards. You can take out credit cards, and that can help you if you make consistent payments on them. So use them, pay them off, use them, pay them off. Again, if you're not financially responsible, and you just have to know this about yourself. You can be setting yourself up for a world of hurt if you do the credit card thing and you don't manage it well and you end up having credit card debt. If you buy a car before you buy a house and then you have utilities that you've been paying off, usually that's going to be more than enough to give you a decent credit score to work off of with debt to income ratio. So again, think about it before you open a credit card. I've seen people open 5 or 6 and be like, oh, I just use a little bit. You're asking for trouble if you do that much, unless you, again, you have everything tied down, just lock and key on your monthly cash flow. You're asking to slip into taking on some debt. And then if you take on debt and you miss a payment or you start to accrue too much debt at that point to where you've used too much, all of those can kind of hurt your credit score at that point in time. But again, it's one of those things. I see a lot of young individuals really trying to focus on, I got to get my credit score. I got to get my credit score. Again, unless you're buying a car, you're buying a house, it's not a huge deal to your financial life. And then on either of those, you should be looking at your ability to afford it with the rate you can get or the market rate anyways. So as far as buying a car, I just want to spend a little bit of time on this as far as what to consider, especially if it's your first time buying a car. Look at used vehicles. Just don't think you have to buy new. And this next one comes into what we were just talking about with credit score. Set a budget, then pick a car. Don't pick a car and try and work your budget around that. That's where you get into, well, if I could just get a lower interest rate, I could afford this BMW or whatever it might be. Pick a budget based on your income and then get a car that fits that. I mean, you can look at a nicer car later in life when you have the flexibility to do it. But if you're just working on everything right now, get something that's affordable that you can still keep your debt to income reasonable and you can continue to save for retirement and won't put you in a tight position later on. Get what you need, not necessarily what you want. Just again, that goes along with picking a budget. The next big one I would say is get your own financing. So a lot of individuals don't know you can finance through like a credit union or a bank. They think you have to finance through the dealership. You can go to a credit union. You're typically going to get better rates there, and you can finance a car there. So you can reach out to the credit union, local credit union first. Like Georgia's own credit union, I think partners with Forsyth County anyways. And then you can be able to get that financing through them and then go to the dealership with that financing already at hand. That saves you from getting essentially haggled over in the finance office. If anyone's ever been in a finance office of a car dealership, it's great when you leave them, but the hour and a half they keep you in there is horrible at that point. So, and I say that like, come from a family of car salesmen and people that worked in finance and car dealerships, and they're just not great places. Focus on the right numbers. I always say that's not horsepower, but monthly payment at that point in time. And then make sure you get insured. So don't buy a Ferrari and then insure it with a General. Just make sure you're getting quality car insurance at that point. Next big purchase is going to be buying a house. So there's a lot of steps of buying a house in its basic form. You hire an agent, you find the right house, you get a loan, negotiate an offer, do a home inspection, and boom, you've moved in, you're in a house. Realistically, it can be more complicated than that. It can be more complicated with a market that we are in right now where home inventories are really low and you're having to kind of work a lot harder on that side of things. Some factors that affect housing affordability, price tag right off the bat, debt to income ratio. That's where it really comes into play again, because if you're looking to get a home mortgage or like go through the lending process there, if you already have a high debt to income ratio, you might not be able to get approved for a larger amount that you would need. But bigger things that affect it: real estate market, economic outlook, whatever interest rates are. And this is going to be interest rates, not looking at your credit score interest rate, but just baseline interest rates. Time of year you're buying, kind of what your lifestyle is, the length of stay. So when you're buying a house, you really are looking at how can I afford this? And there's a couple different mortgage types. We're going to start looking at kind of your more traditional fixed mortgages, and we'll go into adjustable. But your typical fixed, you're looking at either conventional, FHA, or USDA or VA. And like if you're not veteran, you're probably not VA. So I'll look mostly at conventional, FHA, and USDA. So typically, rule of thumb always has been if you can put down 20%, put down 20%. Now, realistically, that is becoming a lot less possible, I would say, over the last few years, just because if you were trying to save to put down 20%, and again, you're saving during this time period where typically your income's a little bit lower, it's very difficult because house costs and house prices have outpaced your savings rate. It might not have been the case over the last 10 years, but the last 3 years, you've probably seen home prices dramatically outpace your ability to save. So that ability to pay down 20%, or even in some cases pay down 5%, might just not be there at that point. So the reality is, if you don't pay 20%, you're going to have PMI. So that's private mortgage insurance at that point. It's going to be added onto your mortgage every month, and it might be 60 or 70 bucks at that point. So, but if you cannot get 5% down or 20% down, you're probably going to be looking at an FHA loan or a USDA loan at that point, where it allows you to put a lower amount down. Now, you might have a slightly higher interest rate at that point. You're going to have mortgage insurance. And just know you are going to be paying more for that house, because if you only put 3.5 or 0% down or 1% down or 5% down, that amount you are taking a loan out on is going to be significantly larger, which means the interest on that will be significantly larger. So I'm not saying don't do it. I'm just saying if you do it, make sure, one, you can afford the monthly payment, but two, just understand, if you stick to that and you don't make more down payments, you are paying far more for a house that if you had a neighbor that bought the exact same house at the exact same cost and they put 20% down, their total purchase is going to be a lot less because of the interest they're paying. They are putting 20% down, so they're only having to take out a loan for 80%. You might be putting 1% down, so you're taking out a loan for 99% of the house. Your interest over the life of that loan will be more than their interest. So just know that if you do that, you're paying a lot more for your house than the asking price, because you are paying a lifetime of interest on there, or a loan lifetime amount of interest on there. So just know that going into it, but you have some flexibility there. Now, with those fixed rate mortgages, you have more options to this, but the two popular ones are 15-year or 30-year. 15-year, it's a higher monthly payment. It obviously pays off in 15 years. 30-year, it's a lower monthly payment, but it's 30 years long. Now, to run the side by side, like all things being equal so just assume like you're looking at two people with USDAs both, or FHAs, or conventional loans. The person that does the 15-year is probably going to get a better interest rate, and they're going to pay less interest over time, which means the total cost of that house is cheaper at that point. But in doing that, the monthly payment's a little bit higher. So if we look at this example, both took out a loan for $300,000. One person did a 30-year, one person did a 15-year. The 15-year got a slightly better interest rate. The monthly payment for the 15-year is a good bit higher, but the total interest paid is a lot less, $134,000 less, because the 15-year had a lot less interest. So the mortgage payment had a higher principal amount every single payment, and the interest wasn't nearly as significant. So if you're doing the 30-year, again, if you can put down 20% and you can do a 15-year, that house is cheaper over the lifetime. If you cannot do that and you're doing a USDA and you're putting down 1 or 2% and you're doing a 30-year, just know you are paying more for that house over the length of that loan term. And that is a significant amount more. So keep that in mind. Again, it's not necessarily inherently bad. It's just knowing what you're doing and knowing you are taking on a lot more debt and you're paying that for a lot longer. Sometimes, again, if you are really needing a home or wanting to buy a home and renting's just not feasible, or rents are going up faster than mortgages, the necessity might be to push that USDA, get that 30 years so that the mortgage payment is affordable. You can always finance to a 15-year later. You can always refinance if interest rates are lower. You can always do an accelerated payment on that mortgage and treat it like a 15-year. So there's ways to work around it, but that 30-year does give you a little bit more flexibility, but you're paying more. So the alternative to a fixed rate loan would be an adjustable rate loan. So an adjustable rate loan is usually a cheaper interest rate on the get-go, but it adjusts over time. So we'll go over an example of adjustable rate loans, but there's typically two different factors when you talk about adjustable rate loans. You have the loan factors, so this, but you also have the cap structures. So we'll talk about both of these and we'll go to an example. So loan factors, you might have like a 5-1 loan or a 10-1 loan or a 5-6 loan, but that first number is the number of years that your introductory rate is fixed. And then that second number is how frequently that rate can adjust after that introductory period. So if you have like a 5-1 period, you might have a 5 or a 3% interest rate for the first 5 years, but then from year 6, 7, 8, 9, 10, the rest of the years, it can adjust once every single year after that. Or you might have a 10-1 where it's introductory rate for 10 years and then it can adjust every time after that. Then you'll have the loan cap structures. So the initial cap, and then the periodic cap and the lifetime cap. So this might be in that same example, if you have like a 5-1. So if you had a 3% introductory rate at the end of year 5, that initial cap, what happens is that's the amount your loan or your interest rate can adjust right off the get-go. So it might go from 3 to 8 really quick, or it might just go from 3 to 4, but it can go up by 5 if there's a 5% cap there. The 2 periodic rate, that is the amount that it can increase every year after that. So if it went from 3 to 4, and then the next year it might go to 6, it could go to 5, but it wouldn't be able to go to 7 because that would be a 3% adjustment. Or you have the lifetime, and also you have the lifetime cap, so it could max out at 8%. So you can never go more than 5% over that introductory rate, which would be 8% at that point. So to look at an example, this is a 5-1 ARM. So a 5-year initial period, then a 1-year periodic adjustable rate mortgage with a 225 cap. So that is a 2% initial rate adjustment, a 2% period adjustment with a total cap of 5%. So it's on an original loan, it's $300,000 with a 6.75% interest rate. So for the first 5 years, you were paying 6.75% as an interest rate. At the end of year 5, year 6, you can have up to a 2% adjustment, which would put you at 8.75. Then your mortgage would go from $1,900 to $2,300. Then, assuming over the next few years you get additional increases, it will max out at an 11.75% interest rate. And then your mortgage payment will jump from $2,300 to $3,000 at that point. This is where adjustable rate mortgages really get people into trouble, because if you can afford the rate, a lot of times people will get an ARM or an adjustable rate mortgage because the rate is well below current market rates on a conventional fixed rate mortgage at that point. So they might not be able to afford the fixed rate, but they can afford the ARM. And they'll probably say a couple reasons people buy ARMs is, I'll refinance before rates go up again, before that 5-year period. So rates will drop back down and I'll refinance. I say that's not necessarily the case. I mean, over the last 3 years, we saw rates go sub 3% for mortgages, which is probably something we're never going to see again in our lifetime. But I mean, you go through the 90s and even the 2000s, like 6% rates were common. So you might not see rates adjust down. So if you don't see rates adjust down, well, there's really no reason for you to refinance, or you might not be able to refinance. And then you're stuck at your rate adjusting up at that point in time, and that mortgage payment becoming unaffordable really, really quickly. So this is what happened actually really dramatically in 2007, 2008. You had a lot of adjustable rate mortgages where the rates adjusted up, and then you just had people no longer being able to afford their mortgages and defaulting left and right. So not necessarily the case now. I'm not making that comparison, but that's what happened in 07 with a lot of mortgages. The other thing is people will say, well, I'll just move. I will sell my house and move prior to that 5-year period. This might be a starter home or whatever. And usually, as I say, life changes pretty quick. It is Very rare over a 5-year stretch, especially at this time period in your lives, like from 25 to 35 or 39, that 5-year period isn't going to change something. So it's very easy or possible that you might not move in 5 years at that point. You could move faster, but don't plan on something that you can't necessarily guarantee and then put yourself in a position where 6 years from now, you're now in a home you can't afford at that point. So just know what you're doing and plan for being able to afford this $3,000 amount. Don't automatically assume it's going to be something you're going to be able to manage around. Now, the final question is, how do I invest during this period? Because what you're looking at is a lot of expenses we just talked about and low income. What does it look like to invest? First off, start small and make incremental changes. So, one of your key strengths during this time period is you have time. You have time to see your assets grow by starting small and making incremental increases. You don't have to jump into a huge percentage of your income being saved. You don't have to put 15% in or 25% in or 20% in. You have time to maybe start with 1 or 2 or 3% and then just increase that steadily every single year, and that'll snowball on itself. But do that because right now you're looking at having to make a lot of major purchases. So a lot of things that involve cash, buying a house, buying a car, having a child, all of these things are expensive at that point in time. And all of these are things typically require some sort of down payment or a cash outlay. So for right now, cash truly is king. And again, at least for right now, but cash is king. As you start to get into some financial stability, you build up an emergency savings, then you can really start hammering investments a little bit harder. But just doing small incremental changes, that way you don't have to start and stop, start and stop, start and stop, or you aren't putting so much in retirement that's not allowing you to build a solid, healthy, like cash flow base and have financial health at the most rudimentary level, build a savings. So you're not having to take on unnecessary debt if you don't have to, because you have the cash to cover it at that point in time. The next thing is just make it easy on yourself. So use your 401k first and foremost. If you have a match, take advantage of it. That's free money going towards your retirement. You don't have to work any harder. You don't have to do anything. Just use the match. Don't over complicate your investments at that point. Don't think that you are going to beat the broad market. Don't think that you can just trade harder and earn a better return. There are literally thousands and thousands of people that their entire careers and lives are dedicated to investing. They're dedicated to trying to outpace the market. And there are a handful in history that have been consistently able to do so. So, using target date funds in your plan, using if you have a Portfolio Express, using that. Don't overcomplicate your investments. The reality is that your job probably isn't revolved around asset management or investment management at that point in time. It's not your forte. If you're interested in it, do a little small account on the side and trade some stocks. But for your retirement, just automate it in a lot of cases. That is the best. Do a simple diversified asset allocation portfolio. Again, if it's in your 401k, use a target date fund. They get a lot of negative flack online, but they're not going to win you any awards for investment returns, but they're also not going to hurt you. And what I see more often than not is when people try and outsmart the market or pace around, their personal biases come into play. They end up either holding cash when they shouldn't, or investing in something that did really well last year that did really terrible the year they actually purchased it. I think ARK Innovation Fund is a perfect example. So ARK Innovation Fund had it was a record return in 2021. So if you looked at it over like a 2-year period, it averaged it was like 50-60% a year. So it's just something astronomical. But if you looked at the average investor return, it was negative because they had a great year in 2021 and a atrocious year in 2022. Well, most of their investors jumped in either at the end of 2021 or 2022 looking at prior year's performance, and all they got was the drawdown at that point in time. So don't try and overcomplicate it. Again, there are people much smarter than me and much smarter than pretty much most of us that do this for a living, and they still underperform the broad market year after year after year. at that point. So make it easy on yourself and just be diversified at that point. And then finally, don't stop investing. And this is where it comes into making sure you're starting small so you don't have to stop when life happens. You have it to where you're able to manage that financial picture fairly steadily, and you're not having to kind of jump in and out of investing at that point. And then don't stop because you either see your wealth go down or because it feels like you're not actually growing. So I hear a lot of people outside of like a recession year where they're like, oh, I saw my account drop in value and I didn't think it was a good time to invest. Don't do that. Keep investing. You're getting the market when it's on sale, when you're in a down market at that point. Companies recover. You're ultimately investing in companies. So if it were to go to zero, that means our entire global economy is completely falling apart. No one is employed at that point, and we're not worried about your retirement or investment returns. If we see a year like 2022 where you're like, oh, well, I lost 20%, you didn't lose 20%. The market recalibrated itself. We had a really record year in 2021, and then companies retool. You either go through layoffs, it's part of the economic cycle, and then they retool. You get new innovation come in. Look at AI this year, or look at automated cars, or look at the internet, or look at any one of those big booms throughout history at that point, or just a run of the mill economic cycle where things get a little bit overvalued. We have a recession, they come back to a more normal, and then companies continue to grow from there at that point. And even if there's not major innovation, you just see change from that standpoint. So if you have a period where the market is down, just know you're buying companies that are on sale at that point in time. And we haven't seen a period like 2022 since really 2008. So this is the first time in almost a little over a decade that you were able to buy companies on sale. So keep investing in all that. But then two, know that it takes time. So most of your wealth will probably be built 12 to 15 years after you started investing. I see a lot of people say, well, I was adding and adding and adding, and it just never seemed like it went anywhere. It's just, it seems like my contributions are the only thing that are adding to this account. I'm not getting any growth. And I always use the idea, it's like, all right, well, if you have $1,000 in your account, you could get 100% return, and you have $2,000. Great. That's not huge. But if you have $1 million in your account and you get a 10% return, well, that's $100,000 of growth. That's pretty substantial. It just takes time for that account value to grow. So usually it's around that 12 to 15 year mark, you start to see the account really make some adjustment. Like if you see a good return year, it's a pretty sizable amount of money. It might be like you saw your salary equivalent of growth in that account. So you start to surpass just the contributions. And most people, when they retire, their 401k balance, about 2/3 of it was built the last decade of them working. So just making sure you know this is a long game, keeping that in mind because it really is something that the dividends pay, but they pay a few decades later. So the earlier you start, that few decades just hits earlier. But just know it's towards the latter half of your career that you're really going to see that account snowball and grow to any significance at that point. But just know that, and know that you need to just continue to be consistent in your savings. Hope this was helpful, guys. Again, next month we'll be doing one on midlife plans. So, like, really when your life starts to slow down, planning in your 40s and in your 50s at that point. But if you would like to sit down and have a individual retirement plan built out for you, like, know, are you on track to retire when you want to do? How do you navigate these major changes in your life? What does your investment picture look like? Are you on track? Regardless of time period you're in, feel free to reach out to us. We can set up an individual meeting and go through our process at that point. And again, everything's covered by the county at that point, so there's no cost associated to Forsyth County employees at that point. But thank you and have a great day.